the first, but before I start, I'd like to welcome Jeff Jones, a new member of the committee. Welcome, Jeff. And go on now to apologies for absence. Have we had any apologies?
Thank you, Chair. Apology from Councillor Michael Locke.
Thank you. And now on to the disclosures of personal and prejudicial interest. Anybody? Yes, Phil?
Yeah, the usual, Chair. My brother's a member of the pension fund.
Phil?
I and my wife are both members of the pension fund.
And I am in receipt of a pension from the pension fund. Jeff?
I'm a member of the scheme, Chairman.
I'm a member of the scheme.
I'm myself, Chair, member of the scheme.
Online? Anyone online? Sam?
Yeah, thank you, Mike. Myself and my wife are both members of the scheme.
Thank you. Patience?
Member of the scheme, Chair.
Thank you. Stephanie?
Yes, same member of the scheme.
Thank you. That's great. Got all that, didn't we? That's fine. Moving on to the minutes of the previous meeting. Go through them. Pages 1, 2, 3, 4, 5, and 6. Any comments on or can I have a show of hands to make sure those minutes are correct? Thank you. Right, there's been a slight change in the order today. I'm moving item 10 to the next item, and this is the item for the Pension Fund Committee to approve a co-opted member, Will Thomas, who was a full member of the committee, but we want him to be a co-opted member. So can we take a vote on that, Chair?
Would you like me to go through?
Oh yes, please. Sorry, Jeff. Could you go through the details? Thank you.
Thanks, Chairman. Just briefly, composition of committees within the administrating authority are outlined within the council's constitution and are constituted along the lines of proportionate representation in terms of the political makeup of the council as a whole. There have been some recent political changes within the council itself, with some changes of individual members changing their political affiliations. This has had a subsequent impact on a number of committees, not only this committee, and therefore, in strict adherence to that policy, would have meant that one of our existing members, Councillor Thomas, would no longer be eligible to be a member of the Pension Fund Committee. Having considered the ramifications of that exclusion of Councillor Thomas, it was deemed appropriate to consider invoking discretions afforded to council to co-opt Councillor Thomas onto the committee and retain his membership of this committee, noting, and apologies to Councillor Thomas who's in the room, but noting his exemplary attendance record, commitment to the work of the Pension Fund Committee, total participation in all of the policy making and investment strategy, horizon scanning and forward thinking and challenge that he provides to this committee. It was deemed it was appropriate to try and retain that expertise and participation, and I'm glad to say it's had the broad support across all political sides of the committee and at broader council that this report and recommendation is approved and supported, Chairman.
Thank you, Jeff. And just to say that I feel exactly the same way, and I'm sure that all members of the committee say that as well. So hang on a minute. So,
I'm glad Jeff explained all that, because I was sitting on the fence chair.
it's nice to put a little humour into the committee. Thank you very much. Right. With that, all that being said, I think we have to have a vote on whether Will can be co-opted onto this committee. So all those in favour, please.
Sorry, Chair, before we actually vote, it's Jeff Jones here. This is the first I've heard. I've no problem with Will at all. You know, I know he does some, you know, excellent work. But this is been agreed by all the leaders.
I believe so, yes.
You believe so? Right. If you believe so, there we are. Vote.
Okay. So again, could we have a show of hands, please? On screen, yes. That's fine, is it?
That's all in favour. That's carried. Thank you, Chair.
Thank you very much, Chair.
Chairman, just for Councillor Jones's benefit, the recommendation is clear on page 459 that Councillor Thomas be appointed as a non-voting co-opted member of the Pension Fund Committee. So Councillor Will Thomas shall not have a vote at committee. However, he can still participate in the work and contribute to the work of the scheme of the committee. However, he does not have a vote.
Thank you for clarifying that, Jeff. We're just calling him back in now. Okay, moving on, and sorry to keep you waiting, Laura. We now have a presentation from our appointed actuary. So this, I believe, it's Laura Arick from Aon, and let you carry on. Thank you.
Thank you, Chair. Jeff, did you want to say anything before we plough in?
Chairman's made the introductions, Laura. Happy to commence. I've indicated to committee, Laura, that you'll be an hour in this training. Obviously, it's a very important piece of training and education. You know, we only get this opportunity every 3 years, I suppose, when we have the valuation. So we should listen intently and engage appropriately for this next hour with you. Thank you.
Thank you, Jeff, and thank you, Chair. Good morning, everyone, and thank you for that brief introduction. So hopefully you can see on the screen, we've got some slides which Eric is controlling for us. So we're here today to give you some training, to remind you of the valuation process, which is something we do every 3 years, and to remind you of the assumptions we need to use when doing a valuation, and to give you an idea of what the 2025 valuation will look like. We'll be back in November. Armed with this recent training, you'll be making decisions about the funding strategy and therefore the assumptions we're making and the results for the fund at that point. So we have a good idea what the results are going to look like, but Eric and I and the team haven't been through all the calculations for every employer. We will have done that by the time we come back in November. So as you can see, the slides are provided in English and Welsh. If you are we're showing them both on the screen at once, but if you are on a smaller screen, you should be able to zoom in to either the English or Welsh, depending on what you want to look at, so you can see it in a bigger if you want to. And we are happy to take questions throughout. Chair, please feel free to interrupt us. If you can see there's a question, we might not see it. But we should have plenty of time for questions after the presentation. I think we've got about 40 minutes of content, so there should be plenty of time for you to ask us some questions. I'm happy to be interrupted. Next slide, please, Eric. Lovely. Right, before we get into the meat of the presentation, I just want to remind you of who we are. As Jeff and Chair said, I'm your fund actuary. My name is Laura Cordwell. I've been working with the Swansea Pension Fund for many years. I'm a qualified actuary and a director in our public sector pensions team based in Bristol. And I'm joined by Eric, who's also a qualified actuary in our Bristol office. And he's, again, been working with the fund for many years. So we know the officers very well, and we understand your employer profiles inside out as well. So next slide, please, Eric. This is our agenda for the training today. So as I mentioned, I'll first of all give you a recap of the valuation process, and then Eric will talk you through what's happened since the 2022 valuation and things we need to consider for the 2025 valuation. I will explain your funding strategy and the things we need to think about in terms of making decisions for this valuation. Eric will give you a bit of a heads up then on the 2025 valuation results. And I will finish off by talking about any valuation related hot topics, as hot as it gets in the actuarial world anyway, and what we're going to be doing over the next few months. Next slide, please, Eric. So let's just kick off with the recap of our valuation process. And we want to remind ourselves what a triennial actuarial valuation actually is. So first of all, we look at the past service position of the fund. That is, we compare the market value of the assets the fund holds at the valuation date, and we compare that with the value placed on the promises that have been made up until the valuation date in terms of the benefits for all existing members. So if the value of the assets is higher than the value of the liabilities, we say there is a surplus or that the funding level is above 100%. If the assets have a market value which is less than the value we put on the liabilities, then we say there is a deficit or that the funding level is below 100%. Where there is a deficit, we need employers to pay contributions relating to their own individual notional funding level and their own individual deficit in order to recover their funding position to full funding. And where there's a surplus, it may be that we reduce contributions to return that employer to a full funding position as well. These adjustments to the contributions for the past service funding position are what we call secondary contributions. As well as looking at the sort of financial health of the past service position of this fund, we also have to consider the cost of the members who are still active, the cost of them building up additional benefits in the future. We calculate these costs as a percentage of pay, and the employer pays the total cost less whatever their membership are paying into the fund. And these contributions are called the primary contributions for future service. When you add together the primary and the secondary contributions, we get the total contributions. Each employer will have to pay their own contribution rate based on their own membership characteristics and their own funding position. In the end, the whole fund position is the sum of all the individual employer positions. And we're required to complete all this work, including certifying all the employer contribution rates by the 31st of March 2026. Next slide, please. So this slide essentially shows you what evaluation really is. The past service position that I talked about involves us having to add up all the liabilities and place a value on those. And the way we do that is we look at each future year and consider the amount of money that the pension fund is expected to pay out in benefits in each of those years. That involves considering current pensioners' benefits and also pensions for their spouses or partners once they've died. It also includes the future payments for any deferred members who've left employment and also the current active members. So as you can see from this chart on this slide, the cash flows go many, many years into the future, and we need to place a current value on each of those bars in the chart. So in other words, how much money do you need to be invested now to meet each of those bars or cash flows in the future? The sum of all of those numbers is the liabilities. So in order to do those calculations, we need to consider both the timing of each of those payments and like how big the payments will be. And so we need to make assumptions about the future. So what assumptions do we need to make to calculate the value of the liabilities in today's money terms? And that will allow us to compare it to the value of the assets that we hold. So this slide sets out the key assumptions we make at each valuation. Most of those assumptions are fund specific. So the assumptions we make for your pension fund would be different to assumptions we'd make for, say, the Cardiff pension fund down the road. They are specific for your fund. We consider these assumptions in two main categories. The teal sort of colour ones there are the main financial assumptions we need to make, which affect the amounts of those cash flows. And the grey bars are the demographic assumptions, and that affects the kind of timing of those cash flows and how long we expect those cash flows to continue for. The main financial assumptions that have the biggest impact on the results are the discount rate and the future CPI inflation assumption. The discount rate is essentially our expected return on assets assumption, and this future CPI inflation assumption is basically how much your benefits are going to increase in the future. The other big assumption is the post-retirement mortality assumption, or how long we expect people to live in the future once they have retired. So I'm just going to quickly look at the discount rate and how we set that assumption on the next slide. So the discount rate is essentially our estimate of how much the fund assets will deliver in returns each year into the future. The vast majority of your employers are long-term secure employers, or they have a guarantee for their funding from an organisation like that. So we can assume they're going to be in the fund for a really long time. And we can therefore base our discount rate on your long-term investment strategy. The way we do this is our global asset allocation team looks at each asset class that you're invested in and sets an expectation for future returns for that asset class. And they also consider how volatile the returns are going to be in the future as well. So what we call that is our capital market assumptions. And we use those to set your expected return assumption for the whole fund. And this also gives you credit for having a diversified split of assets as well. However, this isn't our best estimate. Would be sort of, we've got a 50% chance of being wrong in terms of, you know, our discount rate or our assumption being too high, and a 50% chance of it being too low. But when we're talking about funding for future benefits, we do want to be more sure than that. We need to set an assumption that's more prudent than that. So we set a discount rate so that we are much more than 50% sure that we'll have enough money in the fund to pay those future benefits at all future dates. And that level of assurance is what we call the probability of funding success. The last valuation, the committee agreed to use a probability of funding success of 83.5%. And as the fund is in a strong position, we're proposing to remove some more risk in the funding and increase this slightly at this valuation to 86%. And Eric will talk you through in a moment how our assumptions have evolved since 2022 in a bit more detail. Can I move the next slide, please, Eric? There you go. So what else do we need to take account of when we're carrying out a valuation for each employer in the fund? These are key elements of your funding strategy. I've talked about the level of prudence in the assumptions, and it's important to remember that all the prudence that we set is in the discount rate, which I've already just talked about. All our other assumptions are our best guess of the future without any additional prudence added in. I've mentioned how we take account of the funding security your employers have. That allows us to take a long-term view when setting assumptions for their individual positions. You do have one employer which will ultimately exit the fund in the future and has no guarantees on their funding, and we take a more prudent approach to their funding to protect all the other employers from the risk of having to pay that employer's member benefits in the future. So one key factor in how we deliver stability of contributions and help manage risk is how quickly we recover a deficit where an employer has one, and how quickly we decide to return surplus to employers through reduced contributions. That's a key part of your funding strategy that we'll look at this valuation. Another key factor in helping deliver stability of contributions is how we pool risks. So we do have some employers in the fund who pay a common future service cost rate to help manage fluctuations in membership where they've got small numbers of members in their arrangement. And we do have the option on your strategy of gradually implementing changes to contributions through steps. We typically do this where it's difficult to ask for large contribution increases all in one go. But we'll talk a bit more about some of these measures either today or when we come back to talk to you in November. I'm going to hand over to Eric now to talk about some more specifics on our assumptions and what we've seen in terms of fund experience since 2022.
Thank you very much, Laura. I hope everyone can hear me okay. Yeah, thank you very much. So my section of the slides is about what happened since the last valuation, which took place in 2022. However, before I do that, I want to remind everyone the position of the fund at that valuation. So at the 2022 valuation, the funding position was at 100%, which meant that the fund had equal assets, or all the assets could cover the liabilities. There was a small surplus, so there was slightly more asset at last valuation than required to cover all the liabilities, and the surplus was around 3 million. And then just to remind everyone, as Laura mentioned, the probability of funding success used to derive the discount rate at last valuation was at 83.5%. Right, if we now move to the next slide. So what this meant for the employer contribution is that at last valuation, the primary rate, which is the part of the future service cost paid by the employer, was set for the whole of fund at 21.3%. And as Laura said, each individual employer within the funds got slightly different profile. So the individual contribution paid by the employers were different. And there was quite a big range. And the contribution, the primary rate set for those set for the employers that last valuation was between 18.1% to 40.8%. So quite a wide range. And this related to the membership profile of the employers, and also the assumptions that has been the funding target that's been used for the employer. The high contribution, the 40.8%, relates to that one employer, which is kind of more risky, which has no backing in the fund, and when leaving the fund will leave the liability behind. So that's why there is a bit more prudent assumption used for that employer. As the fund was in a small surplus, there was no deficit contribution set at last valuation. Equally, at last valuation, the committee and the fund taken a decision to only give surplus to employers if their funding was above 110%. And that 10% was used as a buffer to basically provide a security and stabilize the contribution going forward. And again, for each employer, that contribution, the range of the contribution was quite big, and it ranged from minus 24.6%. So some employers did get a reduction because they had a considerable surplus, to 23.3%. So some employers did pay deficit contribution as well because of their individual position. But overall, what it meant across the fund, the contribution was set at 21.3%. Right. So what's happened since that valuation? Let's first focus on what's happened to the assets. So the chart shows the index return on most common asset classes since last valuation till the 31st of March 2025, which is the date for this valuation. The red and the green lines at the top of the charts, the UK and overseas equities. The grayish bar line in the middle is the property. And then at the bottom, we've got the yellow corporate bonds, and then we've got the two bluish lines for the fixed and index-linked gilts. As we can see, the beginning of the period was a bit flaky for all the asset classes. And then, as we know, the gilt, the index, the kind of corporate bond, fixed interest gilts and index links started to kind of drop because the yields on them started to increase considerably following the mini budget in September 2022. And since the period of kind of like a flat return, the equities then started to deliver quite a healthy returns, and been going up ever since, with a bit of a drop at the end of the chart, as you can see. And this is at the time of introduction of the tariffs from President Trump. And the graph shows you the index return, and they not necessarily are a good guide to how the fund performed, because the fund is a composition of different investment. And based on your fund performance, which was really good over the 3 years, the return for the fund was 16.3% over that period. And it was above our expectation, which we set at last valuation, which was at 4.1% per annum. So the fund return per annum was around 5.2%, and our expectation was 4.1. So the fund done really well over that period of time. Right, if we now move over to what's happened with the inflation. At the time of last valuation and at the time of the calculation, we already expected that the inflation will go up and will be spiking around the September time of 2022. And to countermeasure it, at last valuation, we introduced a short-term inflation loading of 10%. So all the liabilities in the funds been increased by 10% to cover that short-term spike in inflation. Because if inflation spikes and the inflation goes up, it means that all the pensions which are paid by the fund need to be increased as well. And that has a direct impact on the value of the liability the fund has to honor. Equally, as I kind of touched on the previous slide, the gilt yields increased, and that had a very minimal impact on the kind of whole of fund assumptions, because they are derived in a different way. They're not directly linked to gilts. However, they will have a kind of more direct impact on those employers which are on a low risk funding basis, those employers or this one employer which hasn't got the guarantee, and the funding target for this employer has kind of improved, and therefore the funding position for that employer is expected to improve as well considerably at this valuation. And it's purely because the gilt yields has increased a lot since last valuation. And just a reminder, if you've got any questions or you want to stop us, then just let us know and we can pause and answer any questions. What does this mean for the assumptions? So
Can I
looking,
stop? Excuse
yes.
me. Rick, can I just stop you? I have one question from Will Thomas. Will?
Thanks, Chair. With regards to the gilt valuations,
yeah,
if they're held out to maturity, that and we get the yield from those, the valuation wouldn't go down as such, would it? But it's only if we sell them early. So if we're invested in those in the long term, the yields going up and down doesn't make much of a difference. Is that correct?
That's correct. Yes. Yeah, if you kind of buy the gilts and then hold it to maturity, then it's just basically pays your coupons and then you get the remainder at the end. And that's correct. It's only when you trade them.
So, sorry, Eric, to interrupt. I think Councillor Thomas may be taking it cross purposes. That's exactly correct what you're stating there, Councillor Thomas, in terms of a gilt investment. However, for this purpose, the reference purpose here, Eric is referencing the gilt yield at that point in time to value the liabilities as required by the regulations. So regardless of whether we hold it to maturity or otherwise, Eric is required to take whatever the gilt price is, the reference gilt price is for that at that point in time to value those liabilities as he's required to do by statute. That's why that particular element there is very little discretion on a low risk basis.
That's
carry
correct.
on. Yeah, carry on.
That's correct. Thank you very much, Chair. And then just to add to that point, the assumptions derived for the fund, the ones which are shown on the discount rate shown on this slide, they do take account that gilt yields at that point, as Jeff explained, but they take all the other asset classes as well and the expectations of the return of those asset classes. So the assumptions are not directly linked to the gilt yields. And as you can see, they haven't moved as much as the gilt yields have moved over the intervaluation period. So at the last valuation, the discount rate was set at 4.1%. And that was with reference to the probability of funding success of 83.5%. And since that point, looking at the same probability of funding success at the current date, the discount rate increased slightly to 4.7%. And maybe coming back again to the chart which I show with the asset classes at the end, just before the March, there was kind of a significant starting drop in the equities, and gilts were already low. So, and when that happens, the future expectation of expected returns increases, because the kind of thinking behind this is that we'll be able to recover some of those losses. However, as Laura mentioned, we're proposing to increase slightly the prudence to 86%, and that results in a discount rate of 4.55%. Looking at the CPI inflation, which is relevant for the pension increases and also for the pay growth, because that's the best proxy for it. At last valuation, we set these assumptions at 2.3%, and that's a long-term assumption. And that 2.3% was set with the kind of like with a bit of that increase in CPI in mind, but not all of that increase. And that's why we've introduced the 10% loading on top of it as well. At this valuation, the inflation has come down. It is still above the long-term Bank of England 2% target, but in the long term, the expectation is that it will go down. Therefore, our long-term assumptions is at 2.1%, so slightly above the Bank of England target. Right, moving on. So that was, so I've discussed the financial assumptions, and as Laura mentioned, we've got two kind of sets of the assumptions. One is the financial assumptions, and the other set is to do with the demographic assumptions. It's all about how the membership behaves, and then in terms of how long the members live, how long they stay in employment, whether they get ill, at what time they get ill. And one of those assumptions, the key assumptions from those demographic assumptions, is the post-retirement mortality. And that directly drives for how long the members will live in future and for how long the fund needs to pay the benefits. So the longer the members live, the more money the fund needs to cover those benefits. And the opposite is true. If members are expected to live shorter, then the fund needs less money. And again, the mortality assumption could be broken into two kind of separate stages of setting these assumptions. The first one is the base mortality, and this is to do with the experience of the fund at the moment and what that experience fits to best and what mortality tables approximate that experience in the best manner, and the future improvements. And the future improvements, once we set the base table, we then need to kind of look into the future and think, okay, this is the experience for the current members, but what about the members which are only 20 or 30 years old, how their mortality will progress? And that's the future improvements. And then in terms of how we do the calculation, as I mentioned, we take the fund experience. We look at the postcode data which we hold on our system. We look at the postcode of the members as well, look at their socioeconomic background, and based on that derive that assumption. So I've already mentioned a bit of that mechanic behind this. So at this valuation, what we did, we look at the fund's membership, look at the latest mortality table produced by the actuarial profession, come up with the factors which best fit to this using our models, and then look at the future improvements I'll cover on the next slide. But the This picture in the middle kind of shows you the how the membership is, how the pensioner population is spread across the UK. And as you can see, the majority where the kind of the red dot is, that's around the Swansea and nearby areas. So most of your pensioners live around the kind of Swansea and that area. And however, there is relatively kind of 10% members living across the UK. So we kind of look at all of those members and look at all of their location to come up with the mortality assumption. Looking into the future, this chart shows you the mortality improvements since the 1975 to 2024. And as you can see, there are 4 distinct sections to this chart. We've got the beginning, the blue one, where the trend of improving in mortality was relatively stable at 1.8%. Then we've got an acceleration of that improvements in mortality between 2000 and 2010s, where that kind of improvement went 2.1%. And then we've got the purple one, where that improvement again flattened to around 0.8%. And then we had the pandemic, where there was a kind of a reset of the mortality. There was a lot of more deaths. Then you can see a bit of a sliding that the improvements might again be speeding up. But recent data shows that they kind of on track with that purple line of improvements around 1% going forward. And therefore, at this valuation, our best estimate assumptions for future improvements change from 1.5 at last valuation to 1.25% at this valuation. So our expectation is that member will live for slightly shorter period than previously expected. Right? What does this mean for the life expectancy? So we've got here the 2022 assumptions and 2025 assumption. As you can see, roughly we're expecting the members to live shorter by around just over a year to a year and a half. And this means that the pension fund will need to pay the benefits for shorter period of time and will need less money. And that change in these assumptions, in the demographic assumptions, will mean that the liabilities will have reduced at this valuation by around 2.5%. So slightly more gloomier view than before, which is not good for the members, but it's good for the fund because it needs less money. Just quickly covering all the other demographics. So as I mentioned, this is to do with setting the rates for when members leave the service, or is the proportion of members becoming really ill, or how long they will stay ill, and also in terms of the promotional salary increases, how much pension they commute. And then again, we've looked at the fund's experience. We've analyzed between 6 to 10 years of past experience. And then most of the assumptions set at last valuation still hold at this valuation. However, we've made a very small corrections or revisions to the rates of members leaving the service. So we believe that there's more members leaving the service now than it was before. And also to the pre-retirement mortality rate, where members living slightly longer before they reach retirement. Right. And then, so I covered the assets, I covered the financial assumptions, I covered the demographic assumptions. And then usually at each valuation, there are some uncertainties, which for which we need to kind of account and include allowance in the liabilities. So we've got enough assets to pay them in future. And then the example of this and the ones we make allowance for, one is the MacLeod underpin. So it's slightly more costly because the members can have an option, not an option, members got an underpin. So they can either take their new benefits post 2014, or the benefits could be calculated in the old way for certain members and certain protections. And at last valuation, we've made a very approximate, or we made an approximate allowance based on each employer's profile. At this valuation, we've been provided with the data by the fund, and then we've used the data to derive the additional liabilities due to the MacLeod. As a result of this, because we've got more accurate data, the impact is that the liability relating to this MacLeod allowance reduced slightly since last valuation. And also now on the horizon, we've got the Goodwin case and the need to equalize the spouses and civil partners pensions for females. And again, this is difficult to calculate and we haven't got the precise data, but looking at the sample fund, we believe the impact on the funding level and on the liabilities will be very modest, around 0.2%. And that's what we've allowed at this valuation. All right, that's any questions? That concludes my part of the development since the valuation, and I'll pass over to Laura to take you through the funding strategy decisions.
Thank you, Eric. And so I think I'll just recap the decisions that we're going to be asking the committee to consider as part of your updated funding strategy statement. So we review your funding strategy alongside the work we do at each valuation. And between valuations, if something changes in regulations which warrants a consideration of the strategy, we look at it then as well. Since 2022, the Scheme Advisory Board has worked with a number of stakeholders, including Aon, to develop new guidance for administering authorities when developing your funding strategy. The previous guidance on funding strategies was quite out of date. So in light of that new guidance, we've worked with officers to update your funding strategy to be in line with the guidance. And essentially the guidance means that external readers or employers who are in multiple different LGPS funds will more easily be able to compare the strategies in different funds and understand the differences that you might have in an approach. So most of your previously agreed strategy elements are still in the new funding strategy as it's drafted. They may just be in a different order. There are some clarifications this time around which set out the suggested stance on things like whether you will allow employers to partially exit the fund and your approach to managing climate risk. But these aren't sort of big ticket items. I'll remind you of the key aspects for consideration and valuation in the coming slides. And the officers are going to carry out an employer consultation on the current draft, which can then be approved by the committee in due course once we've been through the valuation work. Next slide, please, Eric. So the key strategic elements for the committee to consider this time are sort of how much funding risk to take, which we are articulating in the prudence in the discount rate, your probability of funding success. This is all relative to your current investment strategy. So you will likely review your current investment strategy following this valuation, and we'll work with officers and your investment advisors to ensure we've got a joined up approach which balances out managing risk and cost to employers. We think slightly reducing the funding risk now when we're doing this valuation, it gives you more flexibility to select an appropriate investment strategy without increasing employer contributions. Most employers will be in surplus at this valuation, so a really key consideration will be how quickly we release that surplus to employers through reduced contributions. And the key decisions around surplus recovery will be, firstly, over what time period we spread surplus to reduce contributions. As most employers are long-term, using a long period to return that surplus makes sense. Another consideration is actually how much surplus to return. So do we target a funding level of 100% or do we target something higher? And where we set that level, we'll need to consider how confident we are in the surplus we hold being maintained in the future. And that relates to future market conditions. We also need to think about how we deliver stability for employers. We know how difficult it can be to ask employers to increase contributions especially given current budgetary challenges. So we want to avoid having to do that in the future. And we also want to consider how quickly we move to new contribution rates. As we're probably going to be talking about potential reductions, we probably won't apply a stepping approach. That's typically used where increases to contributions are difficult to manage. Can we move on to the next slide, please, Eric? So we just wanted to, I'm not going to read all the words on this slide. This is more for your training, for you to refer to later if you need to. We just want to look at a few of these areas in a bit more detail. So if there are still any employers in deficit at this valuation, we're proposing to target the same end point, so recovery date, as we have done in the last few valuation cycles. So that reduces the actual period to recover by 3 years since last time. In 2022, as Eric sort of mentioned, we only agreed to return surplus to employers where they had an individual employer funding level above 110%. And we would target that recovery to 110%. So kept a buffer of 10% of surplus, given the market uncertainty at that time. Given there is still a lot of uncertainty, geopolitical tensions, a non-trivial risk of recession in UK and other countries, we propose to increase this buffer to 100%, to 120% at this valuation. Given we're expecting a significant contribution reduction, and in light of even with that 120% increase, we still think this feels reasonable, but we can talk about that in due course. And as I mentioned, we'll probably move straight to new rates where reductions apply, so we won't step down. Next slide, please, Eric. So there's really no change to how we categorise the employers for setting their liabilities. In terms of the risk they pose to the fund and other employers, the sort of strength of their covenant hasn't really changed. But since 2022, we have agreed with the one employer who was on a a higher risk approach or a low risk funding target. We've agreed that given their significant improvement in funding position on a low risk basis or a gilts basis, we're going to stabilise their position by operating a bespoke notional gilts-based strategy for that employer. And that targets their position when they exit the fund. This doesn't affect the other employers in the fund other than reduce the risk of any deficit falling on them when that employer does exit. And it also reduces the risk of having to pay a large surplus out to that employer when they exit as well. So as I said, there's no other changes to employer risk and therefore how we set their funding target or their assumptions. So that's the main parts of the funding strategy I wanted to draw your attention to. Eric, do you want to give the committee an idea of what the results will look like in this valuation? Oh, and just before we do that, actually, Eric, I thought there's a new member in the committee. I don't think we had actually mentioned this explicitly, but when we set a lower discount rate, it means we need more invested now to meet the benefits in future. So a lower discount rate means higher liabilities and therefore a lower funding level, and vice versa. So where we see an increase in the discount rate, that reduces liabilities and improves the funding position. Just always worth clarifying that before we move on. Anyway, Eric, over to you.
Absolutely. And maybe just to add to that point, because the other key assumption is the kind of the inflation assumption, and that's got the opposite effect. So if you increase your inflation assumptions, then you're increasing your liabilities. And if you reduce your inflation, then obviously you're reducing your liabilities. So that's the two kind of mechanics behind the key financial assumptions. Right. Without any delays, I just want to take you through the initial results of the 2025 valuation based on the assumptions and the bits we've already covered. So as mentioned before, at 2022 valuation, the funding position was just above 100%, but it was reported as 100% after rounding. The surplus was around 3 million. But at this valuation, based on new financial assumptions at this valuation date and with the increased probability of funding success of 86%, the funding level for the whole of fund is at 122%. So an improvement of 22% over the 3-year period. And now the fund has a very healthy surplus of over £600 million. Right, this is the key message from this. And then just to give you an overview of the key reasons behind that situation. So the graph shows you the reconciliation between the surplus at the 2022 valuation to the surplus at 2025 valuation. And as you can see, the dominant bar, which increased the surplus over the period, is the change in financial assumptions. And this is to do with the change in the discount rate. So our discount rate assumptions increased from 4.1% to 4.55%. But still, we've increased prudence within that discount rate. The inflation assumptions reduced from 2.3% to 2.1%. And again, that reduced the liabilities. And the combined impact of that is the kind of gain of over 300 million. Next on the chart, most significant movement is the investment profit. And this is to do with the exceptional return the fund delivered over the 3 years period, which was 16.3%. And then which I believe was one of the best amongst all the other LGPS funds. We also then have got the kind of third biggest bar on the right is the change in demographic assumptions. And this is just added just under 100 million to the surplus. And this is what I explained before. This is purely driven by that expectation of future life expectancy is slightly lower than it was at last valuation. And just to reiterate, all the assumptions which we set at this valuation and last valuation, apart from the discount rate, are best estimate assumptions. Right. Any questions at this point? I can. No? All good? Relatively very good news. And what does this mean for the contribution rates? So this slide summarizes the 2022 primary rate and then the initial 2025 valuation results. So at last valuation, as already mentioned, the employer cost, the primary rate was 21.3%. At this valuation, this contribution reduced 16.7%. And just to add that, as I explained with the liabilities and some uncertainties around the MacLeod and Goodwin, those allowances are included within the liabilities. They're not included in this future service rate because we believe it's all in the past. It's to rectify the past benefits. But looking forward, the revision to this, the cost of benefits and the benefits for the scheme could be driven by the cost management process. However, as both the 2016 and 2020 cost management processes have been concluded and not recommended any change to the benefits, we have not included any specific allowance for any changes to future benefits in this contribution rates. Then equally as for the liabilities and the surplus, this shows the reconciliation and the key reasons behind the change in the primary contribution rate since last valuation. And again, the main driver is the change in financial assumptions, the increase in the discount rate, reduction in the CPI, and change in the demographic assumption. Right, and now moving on to the final kind of summary in terms of the contribution. So what does this mean? So the fund position, the balance sheet, and the primary rate, what this mean for the total contribution rate across the fund. So at last valuation, and the primary rate was at 21.3%. There was no secondary rate because the fund was just above 100% funded. So the total employer rate was at 21.3%. At this valuation, the initial results, the primary rate stands at 16.7%. And because the fund is over 120% funded, we are giving back some of those assets to employers by reducing their primary contribution. So across the fund, the reduction is around 0.9%, resulting in the total employer rate at this valuation of 15.8%.
Eric,
Yes.
just to confirm, this is a whole of fund results,
Yes.
and
This
those
is whole of
figures can't be attributed to specific employers. In due course, Eric and Laura will calculate the impact for individual employers, which will be either plus or minus 15.9%, depending on their profile, their membership, their share of the assets, etc., and what basis they've been adopted. That's whole of fund results. So please don't assume that is applicable to, for example, Phil, to Neath Talbot, and for ourselves, that's not directly applicable to Swansea Council as such. That's whole of fund, including all employers.
That's correct. And as shown at the beginning of the presentation, the range of contribution rates for within the fund is quite wide. So we could have employers which pay 0 contribution to employers paying above the 20% contribution, depending on their individual position and funding position for them and the membership profile.
Eric,
Yes.
Eric, I have a question from Bill.
Thanks, Chair. I'm just confused as to this is a recommendation to the committee. It's set, is it?
It's not a recommendation as yet. This is purely educational.
Yeah.
This is an output as a result of the assumptions and principles that we've agreed with officers and the actuary to date, which will be enshrined in the funding strategy statement, which is to be approved at next committee. These are very much working assumptions as we speak.
Okay, so still a bit to do, but what worries me, I mean, it's obviously to be celebrated that the fund is 120% funded, fantastic. But as Laura mentioned earlier, there's big geopolitical tensions around, and I think also if you look at some of the value to earnings of some of the big Magnificent Seven stocks and things like that, I mean, I wouldn't be surprised if that changes dramatically overnight one day. So I'd be much more cautious personally than 120% about that. So.
Well, that's heartening to hear, isn't it, Laura and Eric? Because we
anticipated what we were going to say.
We were very much fearing that perhaps committee may have argued that we were being too prudent at 120%. We have in our discussions and deliberations built in a lot of prudence into the valuation assumptions, and thanks to Laura and Eric for their guidance and professional judgment in applying the appropriateness of that. And they've indicated that, again, due to the work of this committee and advised by our consultants, Hymans, we've de-risked the investment portfolio in that we were switching from growth assets and building a yielding real assets portfolio to safeguard the investment strategy of the fund, to provide it a bit of resilience. Hence, the change in financial assumptions going forward. The discount rate that's referenced by Laura, they've been able to take a bit of risk out of that because of the changes that we've made to the investment strategy. So all these considerations, work of this committee that you've done in the last 10 years or so, have led us to this position, being able to apply, we think, an appropriate level of prudence. But I take your view, Councillor Thomas, very much so. That's why we're at this position, and we want to hold on to that 20% surplus to safeguard against those future shocks that, you know, I'm old enough to remember a position when this fund was 72% funded back in the dark days. They were talking about stopping the LGPS, unaffordable, etc., etc. So now we're in this healthy position. I, like you, want to safeguard that position for future generations, future members of the scheme. So but between our professional advisors at Aon and Hymans, we've reached this position whereby we hope by implementing this revised investment strategy, there's a degree of resilience and robustness within that investment strategy, but also within the assumptions adopted by Eric and Laura within the valuation itself, provides us with a bit of fat within that valuation to safeguard us going forward. Yes.
Yeah, and Eric's got a slide on what happens if the bottom falls out of the universe, and which you'll come to. But I think as well, as Jeff has kind of alluded to, I don't think we're going to crystallise the probability of funding success in the strategy that you'll be signing off on. I think we sort of say what it was at the last valuation, and we don't have to crystallise that, so that if something does happen before we sign off these contribution rates, we can dial back that prudence a little bit if we need to. Like the level of prudence that you had at the last valuation was still perfectly prudent. We're just trying to take some risk out where we can. So we do have some levers we can pull if we need to make sure those costs don't sort of rocket up in the future for the employers. So, but yeah, I think Eric's it's probably best if you kind of show your kind of sensitivity slide, and then that kind of shows that we have thought about this when we're setting these contribution rates.
Absolutely. So my next slide, which was also kind of covered by Jeff, it's all about the individual positions for employers, that they will be different from that whole of fund position. Every employer is different, and the range of contribution will also be different. However, the general direction of travel is for all employers similar to the general direction for the fund. And then now looking at the kind of sensitivity of the results. So the funding level, at the initial funding results indicate that the funding level is at 122%. However, as we kind of said, that there is a lot of things which could go wrong. And this kind of illustrate that even that some of the kind of shocks could easily take out that kind of buffer we've got of 20% above the 100%. So, for example, if we believe that life expectancy will actually increase at next valuation, and this could be to do with development in medicine, maybe the kind of issue with the obesity drugs, they will kind of have some magic improvement in life expectancy, then that would reduce the funding level by 6%. And then if we believe that our discount rate will fall because the expected returns will be a lot worse than we expect, let's say it falls dramatically by 1%, then again the funding level will reduce by around 19% to 103%. Similarly, if we believe the inflation will spike up and go up and we need to increase our inflation assumptions by 1%, that again will result in a funding level of 103%. If we look at the equity markets, if we believe they drop by 25% overnight because some random movement from President Trump, then again the funding level will drop around 20%, because not all the assets are invested in equities, but they are kind of correlated with that returns. So as you can see, this kind of like illustrates the key risk which we're facing when setting the assumptions and the magnitude of the correction to the funding level if anything happens. But as explained by Laura and Jeff, we've built enough fat into these assumptions which we're proposing for this valuation, that we've got enough room that if even something dramatic will happen, the contribution rate will still be relatively stable and probably will go down at this valuation. Right, that's last slide from me. Any questions before we move to the final section of hot topics?
Hot is a relative term, so should we say lukewarm topics? We are actuaries after all. If you could move to the next slide for me, Eric. So these are just things that we need to be mindful of when we're doing this valuation. What we do now in each valuation is when we've completed our work, the Government Actuaries Department is appointed under Section 13 of the Public Service Pensions Act 2013 to carry out a review of all LGPS funds in England and Wales altogether and sort of compare them with each other to make sure there isn't one fund doing something that's completely rogue, or, so they're looking for sort of consistency, not of assumptions, because every fund does its own thing and that's appropriate, but consistency of like approach and the way they consider things and making sure that nothing is missed. And making sure that a sufficiently prudent approach is taken to ensure under the regulations you're ensuring the long-term cost efficiency of the scheme, so not kicking the can down the road for future generations to pay costs for current generations, and the solvency, so making sure you're being sufficiently prudent, which we obviously think you are. So the process that happened in 2022, where Government Actuaries Department reviewed all the funds, there were no flags. So they have a series of different flags they can raise if they have any concerns under lots of different metrics. They didn't have any concerns about the Swansea Pension Fund in 2022, and we do not expect they will have any when it comes to reviewing the 2025 valuation if we carry on with what we're proposing in this presentation, and then when we come to in November as well. But we will consider, we don't know exactly what they're going to ask and what they're going to measure. We've got a good idea now, so we're pretty confident. One additional development that they are looking for, which relates to what we've got on this slide as well around access and fairness consultation, is looking at gender pension gap reporting. So this doesn't really affect your liabilities or anything like that. It's more, as actuaries, we have access to all of your fund data at a certain date, so it's quite easy for us to do some calculations looking at average pensions for males, average pensions for females, and comparing the difference. And this is going to be part of the Government Actuaries Department review. They want to see that everybody's reporting on this. So that will be included in your valuation report. It's really just a statistic, but you as a fund may want to then use it in member communications. It only has to be reported in the valuation report under the proposed regulations. But it is quite interesting, and it can help increase member engagement with pensions. So it's quite a topical issue. We've already done some sort of analysis based on your 2022 results for the Swansea Fund, so we will do that relatively easy for the 2025 process. And then there's other little things which we think about. So there's obviously been a recent Fit for the Future consultation, which affects pooling, as you will be well aware of. We don't see that having a big impact on the valuation this time around. It may be that the costs of moving to FCA authorisation and things like that for the fund, you may see a short spike in costs, which we reflect in the next valuation results when we're setting contributions and things like that. But really, we don't think it's going to be a significant thing to consider for this valuation. And Eric's already alluded to some of the things that are coming through in the latest consultation on access and fairness, which is a consultation around improving benefits for certain members in the scheme around things like dependence benefits, making sure they're all sort of equalised, and sort of access to lost pension for people who've been on leave, for child-related leave and things like that. Again, we sort of make broad assumptions about these sort of things anyway, so these really won't affect the liabilities as far as we see them, apart from where Eric's called out about the Goodwin, which is a very small change. So overall, we don't really think there's much to say. It's good to make you aware of these things. But that's pretty much it. In terms of the next slide, which is my last one, this just explains our sort of timetable and what we've got to do next. So we will now go away and finish off looking at all the individual employer results, and subject to the committee agreeing to our assumptions in the next meeting in November. We'll share those draft results with employers, and then we have an employer sort of meeting in November as well, following the committee meeting. And then we have a few months to kind of finalise everything, put it all in a report and a certificate for the employer contributions ahead of the next the deadline, 31st of March. So that's it in terms of our training. We are more than happy to take any other questions, although I appreciate we've actually gone and taken the full hour already. But if you do have any other questions, I'm happy to take them. And thank you for listening so patiently. I know it's quite a lot to take in, but we will go through a lot of this again when we talk in November, just to help you make the decisions.
Thank you, Laura. Any questions for Laura? Jeff?
Thanks, Chairman. And not a question as such. I just want to place a record. Thanks to Laura, Eric, Emily, and the team at Aon for obviously the planning for this trial evaluation. Didn't just start in 6 months ago. The planning and the prep for this has started a long time ago with their intra evaluation, data cleansing exercises, etc. With Claire and Nick and their teams. So as I understand it, we're one of the first employers within the Aon stable to declare valuation result for 2025, and I very much thank Laura and Eric for turning it around quickly, because it enables employers then to use those figures for their planning assumptions for 26, 27 moving forward, and as much visibility and certainty that employers can have in respect of that moving forward is a great fillip to them in these uncertain times. So I want to place on record my thanks for their support, guidance, and flexibility and sensibleness in discharging their duties as the appointed actuaries for us this year. And see you in 3 years' time, hopefully. Not that I don't want to see you beforehand, but yeah, see you in 3 years' time.
Thank you, Jeff. We move on now. So we're on Rich's report, is it? Yes.
You're welcome to stay, guys, but obviously we're a huge agenda, and obviously you can log off if more appropriate.
Thank you, Chair, and thank you, Jeff. We'll disappear now, but obviously if there are any other questions, Jeff, I'm sure you can channel them through to us in due course. But thanks all.
Thank you very much.
Thank you very much for the presentation.
Thank you.
Moving on to item 5, which is the breaches report, and this is over to you. This is just for information, but for you, Jeff.
Very, very quick one, Chairman. For the first time ever, no new breaches to report since the last reports.
Yes, certainly. Yeah, come in, Will.
Sorry, it's not to do with breaches as such, but when some of our members, they get their lump sum, their tax-free lump sum, and they ask for that to be withdrawn. Obviously, there's a lot of scams going around, and a lot of people are, saying invest in this, invest in that, and people getting tricked into things. Do we give any information out when people withdraw those funds to say, obviously it's their money, it's up to them what they do with it. But do we make people aware of or advice about potential risks? Thanks.
There's regulations outlining this and our obligations as an administering authority. So there is correspondence, both. I think any correspondence you have with the fund, there'll be some warnings at the bottom of it, and your annual benefit statement will mention it as well. But in terms of pensions liberation, because obviously members do have the right to move their pensions elsewhere, and that tends to be when they're targeted by these companies, and we're required before we release the funds to ensure that they've had appropriate or taken financial advice. We can't police this stuff. We can just ask the question, because as you say, it's their money. They're grown-ups, but we have to ask the question that they've taken financial advice. What that financial advice is, we don't second guess that, but we're legally required to ask that question.
And is it just last question? Sorry, is there any time limit on how long does it take the funds? Is there like a cooling off period, for example, if someone was to say, invest in this is great, transfer your pension, do we do it straight away, or does it take a month or 2 or 3 months to withdraw the funds?
As you're aware, local government organisation, we don't move with great alacrity, as you're aware. So it does take a while, and that speaks to your concerns. You know, it's cooling off period. So yeah, they submit that request, and it will take a while to turn it around.
Thank you, Jeff, for that. Moving on to item 6, which is draft City and County of Swansea Pension Fund Annual Report and Statement of Accounts 24-25. And I believe this is you, Jeff.
Thank you, Chairman. Yes, this is the annual document that Pension Fund Committee are required to approve. It's the the main statutory document which outlines the financial health and gives you assurance as those charged with governance about the systems of control and governance around the management and discharge of our duties as an administering authority of a pension fund. You know, it's you know, we get this report, and Karen very diligently produces a report, and I'd like to place on record my thanks to her for producing it on time and handing it over to the auditors who are at this moment auditing this annual report and financial statement, with a view to bringing their report to you in November. But as I say, we produce this on an annual basis. You get this on an annual basis, outlining the financial health, mainly regarding the assets, as you can see within the report. However, it's quite pertinent that you're receiving this report then at this time of year, every 3 years, when you can view it alongside the financial health of the liabilities, because we only really look at the liabilities in depth, in detail, every 3 years when the actuary does their valuation. And as they've indicated, the fund is in rude health in terms of the level of their assets compared to the level of their calculated liabilities at this point in time. As you can see, this document, again, its content is largely dictated by the Scheme Advisory Board guidance on what should be contained in an annual report. And as you can see, it's a pretty hefty document that we've got here now. So you'll be pleased to know I'm not going to go through it page by page. I'm just going to draw out some key statistics from the document, which perhaps resonate with what the actuary has told you previously. So if I could ask you to turn to page 43 of your pack, or page 3 of the annual report, we've got the 3-year profile of the fund in terms of the key statistics, and to draw out a point made by the actuary in their presentation. If we can see at the bottom there, in terms of the number of contributors, you can see there across the 3 years highlighted there, you can see the number of contributors has dropped for the first time year on year, from 22,703 to 22,357. So what does this mean? This means we have less new members in the scheme, and as you can see, the number of pensioners has leapt up, and this speaks to the demographics that they referred to. One of our largest employers in the scheme, Swansea, has a very aged profile, and as you can see from these stats, quite a large cohort of members have exited the scheme in year from those stats. What does that mean for us? It accords and is consistent with the investment strategy that we've implemented alongside Hyman's, our investment consultants, a number of years ago now, whereby we are reallocating growth assets into income-bearing, income-yielding assets like property, infrastructure, real estate, natural capital, which throws off income as a key component of their investment return. Because what these stats mean is that we as a fund now are cash negative, and I will refer that when we move to the fund account. You can see we have now flipped into cash negativity, so that moving forward, cash flow management will be an important consideration for this fund, because we shall need cash income to pay those pensioners going forward. Also, another impact of the very good valuation outcome that we've just received from the actuary This will result in, you've done the mental arithmetic in your heads, that will result in material employer contribution reductions going forward. What does that mean for the fund? It means we will receive less cash from our employers going forward. Therefore, we will need to generate more cash as a fund from our investments to meet our liabilities going forward. But again, that is consistent with the investment approach that we've adopted previously and approved by this committee by investing in more income yielding assets, more coupon yielding assets, more assets which pay dividends so that we can pay our liabilities as they fall due. And to that, Andre in his consultant's report later on will reference the short-term dip in performance that we're experiencing as we implement that, and he'll reference the drag on performance in J-curve and time to deploy those assets. But it is envisaged that will be temporary, and as those assets start bearing income, that will slowly move out of that J curve. And it would be, if I could, Chairman, I just want to share on screen just a report that we've received very recently about the investment. I can see Jeremy. I'm going to ignore him because it's just a slide, Jeremy. It's purely just a slide. Hopefully, you'll bear my indulgence in this respect. In that it's a report which outlines the long-term investment performance of the fund, and where is it now? Annual reports. Here we go. Sorry. Just hang on. Just is it going to come up? Bear with Sharon. So it's a long-term perk report outlining longer-term performance of the fund. This is a universe covering the whole of the LGPS, and it looks at the investment return performance of other similar LGPS funds. And this is a page outlining our performance over 3-year, 5-year, 10-year, 20 years, and 30 years. And as you can see there, alongside the narrative, in all longer-term periods outside the 20-year period, we are no lower than fourth. And as indicated by Eric and Laura in their presentation, we're the best performing fund during the last 5 years. So those performance metrics are something to be proud of for this fund. It's not a short-term blip. It's a demonstration of long-term consistency in performance, and demonstrating the commitment and resilience of the investment strategy that you've implemented. Sorry, Councillor Thomas, you got a question?
Yeah, so is that Wales or the whole UK?
That's the whole of the UK. That's the whole 86 funds within the LGPS universe. I received this over the summer. This is published, and shared with all funds. So, that ranking across the bottom is something definitely, to be proud of. But to manage expectations going forward, obviously, we are taking investment risk out of the portfolio at the moment. We're reducing those riskier growth assets. So these outsized investment figures that we've experienced most recently, we need to manage our expectations going forwards. We won't be top of the pops, top of the charts going forward, because we are taking some of that high octane stuff out of the portfolio and reallocating it into more dependable, resilient, income yielding investments instead. However, we're still an open scheme. We still have to take investment risk, and there will be a degree of investment risk within the portfolio. But I just wanted to share that slide with you. This report is produced independently by PERC and LAPFFF, and it's quite encouraging that their comments are so positive in terms of our fund's performance. And I also wanted noted that I started working for this authority 22 years ago. So the 30-year figure has nothing to do with me, the 14th place. Thanks, Chairman. That's that. Other areas of the report that I'd like to draw your attention to are on page 128 of the pack and 88 of the report, where the actual statement of accounts starts. And there you can see, the increase in fund value in year of £153 million. But again, on page 89 and 129 of your pack, you can see there the relationship which I alluded to earlier on, the net additions from dealing with members at minus £14 million. So basically, the contributions that we're receiving are not enough to meet the liabilities that we're required to pay during the year, and we're in deficit in the last year of £14 million. So that's what I mean by cash flow negativity. So that we are now, for the like last year, are having to rely more and more on investment income to start meeting those pension liabilities. Historically, we've always been cash positive, but obviously, due to all the reasons provided previously, we are now cash flow negative.
Just a quick question on that. So obviously that means we have to sell assets to, plug that gap, I suppose. Does it come off of a percentage of everything at the top, or how do you decide what you sell?
Well, to my point, Councillor Thomas, we because of the way we structured the investment portfolio, we don't actually have to sell investments. We have investments that throw off cash in the form of income. For example, our property portfolio, our tenants have to pay rent. So we collect that rent and use that rent to pay pensions. Our private debt portfolio pays coupon, pays interest. We use that interest to pay our pensions. Infrastructure, they pay management charges. We collect those management charges and pay pensions. So it's using that element of the income bearing portfolio to meet our liabilities. So we don't have to be distressed sellers and forced sellers of assets. So sorry, Andre wants to.
Yeah, just to come in, I don't want to steal the thunder of our presentation in a few minutes' time, but certainly I think there are two forces at play here. One, which I think you raised earlier, which is the fact that some of the equity markets are quite high and quite concentrated at the moment, so there is naturally that risk there with the large equity allocation. And then the point we're raising now, which is around income and kind of reshaping the portfolio to make sure that it naturally meets the income needs and the cash flow needs of the scheme and of the fund. And I think both of those tie in really nicely together, because naturally, as you reduce your growth allocation and increase the income allocation, which does take some time, and as Jeff correctly alluded to, it takes time to deploy capital and to deploy capital so that the returns are strong. But both that reduction in growth assets and also the increase in income assets to meet these cash flow needs really tie in nicely together. And it's I guess you're at a bit of a crossroads, but certainly the fact that the funding position is so strong means that the investment profile can evolve to meet those needs pretty naturally. And we'll come back to that.
Do you want to go in?
Thank you, Chair. Just asking on that. Obviously, I noticed last year we were 12 million cash flow negative. We're 40 million. Obviously, it's going the wrong way at the moment. We are changing our investments, as Andre has pointed out. Over what time scale are we expecting it to come back into being level? Are we looking like 2 years, 3 years, 4 years, or is it longer?
It'll get worse in terms of cash flow negativity, Councillor Rogers, because as we indicated, we're going to be asking less of our employers to come in. So that figure you can see on that page there in terms of contributions in, that will go down in respect of our employers by a considerable margin. So that position whereby we're not cash flow negative as a fund, because as you can see at the bottom there, net increase in fund value is 153 million in that large black figure down below. It's only in our dealings with members that we're cash flow negative. Because as I say, the rest of the investment portfolio is throwing off a huge amount of cash with which we can meet our liabilities. It's only drawing your attention to the fact that in our dealings with members, i.e. collection of contributions in and transfer income and other income, we are in a cash flow negative position. As I say, the investment portfolio is structured so that a growing proportion of it now, and plan to grow even more, will throw off cash as a natural function of their investment return.
Jeff, I've got Sam wants to come in online.
Thank you, Mike. Yeah, just hopefully got a simple question, Jeff. In terms of being cash flow negative, you mentioned that one of the reasons for that was an older, contingent. Then, can I just ask, is that in terms of is that the only factor? Or is it that is it just the aging workforce that's a factor, or is it a factor that the younger workforce isn't actually joining the pension scheme? Because they're two different causes, if you see what I mean.
Your comment is right that you know that the scheme as a whole, as you can see, is contracting in that regard. It is still an open scheme, Councillor Pritchard. There's no impediment to new members joining the scheme. However, the public sector as a whole is contracting, I would suggest, and obviously lots of employees in the scheme, not in the last couple of years, but prior to that, had ERVR schemes in progress to encourage older members of the workforce to retire, basically, and become pensioners. So that was a cause of lots of people moving from active membership to pensioner membership. But the degree of new entrants to the scheme, it's not prohibited by any regulatory changes, because if anything, there are measures such as auto enrolment. In days gone by, a new council worker would have to opt in to join the scheme. However, now they are automatically enrolled into the scheme as a default, and then they have to actively opt themselves out of the scheme if they don't want to. And I know there's a lot of education from the unions and employers about the benefits of remaining a member of the scheme. However, as alluded to earlier on, members have free choice. Cost of living crisis, etc. They may rather keep their pension contributions in their pocket than save for their retirement. But I just want to reiterate that the LGPS is probably the best retirement saving that any young person could possibly make in respect of their retirement planning.
Have you finished, Jeff, or you want to go? Yep. Okay. Oh, sorry, Patience, I didn't spot you there. Do you want to come in? Thank you.
That's all right. Thank you, Chair. Jeff, just to follow on Sam's question about people leaving the scheme and how that's kept us now in a cash flow negative position. If any, do we know what the risks are to the scheme of this?
As I say, Councillor Bentu, the risks are mitigated by the investment portfolio that we have, which throws off investment income as a key component of his investment return. We do have cash coming into the scheme from our investments to meet those liabilities. So from a risk perspective, as far as the scheme is concerned, no, it will take careful management, because obviously we have other cash flow demands as well to meet our capital calls that our investments require, and it does complicate matters. Councillor Bentu, you're right in identifying that, and it adds complication to the management of the scheme, but it poses no exigent risks as such to the existence of the scheme at all.
Thank you, Jeff. We move on now.
Yeah. Thank you, Chairman. I think Laura alluded to some changes that arose out of the Fit for the Future consultation and the work that the Scheme Advisory Board is doing, updating guidance across a number of publications, including the funding strategy statement that she referred to, but also they updated their guidance in respect of the annual report. And a couple of new things that were required to update within the annual report is committee member training, and that's on page 151, 1111. I think we have long reported on committee member training, but that's outlined as required on page 151, 111. And then it would be remiss of me not to mention the admin report on page 44 and 4, which, you know, let's make no bones about it. This is why we're here, to pay members and our dealings with members, and it is, as outlined from page 44 onwards, a complex scheme, and in those pages outlines all the work that's gone in to incorporate the legislative changes and to comply with regulations in our dealings with members and employers. And we've got a report later on the agenda which updates our pensions admin strategy statement, again that represents our contract with our employers and how we deal with them and how we discharge our responsibilities as an admin authority. Governance on page 84 and 44 of the report. It's the governance strategy statement, required to include it. Again, councillors may be familiar with that document because it's replicated in the accounts for the council as a whole, because largely we rely on the governance arrangements of Swansea Council, because Swansea Council is the admin authority of the pension fund. But moving forward, again, Fit for the Future consultation requires some updates and revisions to governance requirements, and in due course this committee will be subject to an independence governance review, which is legally required every 2 years. So you'll have external auditors coming in, kicking the tires, seeing how this forum works, ensuring that, you know, I'm telling you what you need to know, you're making the right decisions in that respect, and so they will challenge and review that we have appropriate governance arrangements in this authority, including the work of the local pension board. Obviously, the local pension board sits parallel to this committee, and they provide the scrutiny function to the work that you carry out. As I say, this won't be the last opportunity you'll have to ask questions about this document. This will come back before you post-audit in November for your final approval. This is presented to you today in draft format. As I say, Karen has submitted it to our colleagues in Audit Wales, who are busily going through it with a fine-tooth comb as we speak, and they'll come back in November to present their findings to you alongside the final version of this report. Happy to move the recommendation, Chairman.
Thank you, Jeff. Thank you for that report, Jeff. This requires approval by the committee. So could we take a vote on the report, please?
Thank you, Chair. You see the recommendation on page 39, and it's recommended that the Pension Fund Committee approve the draft City and County of Swansea Pension Fund annual report and statement of accounts 24-25, subject to audit, attached at Appendix 1. Can I take all those in favour, please? Okay, that's unanimous and carried. Thank you, Chair.
Thank you, Jeremy. Right, moving on to item 7, which is controls assurance review reporting. This is just for information, but it's over to you again, Jeff. Sorry.
Oh, thank you, Chairman. This report is before you and is wholly resultant of a formal audit recommendation from Audit Wales. I think it was about 2 years ago now, Chairman. And what these, pretty hefty and dry documents you have before you are controls assurance reports from our key service providers and investment managers. As you know, we discharge the majority of our investment responsibilities via third parties, professional fund managers, etc. And to give you assurance that their internal controls and systems of control frameworks are robust and provide you with adequate assurance that the assets are appropriately managed, they are also subject to their regulatory requirements, independent audit. And what you've got here are 2 full independent internal audit reports in respect of Russell and BlackRock, because they manage the majority of our assets. So we thought it prudent that you see those reports in full. And also as an appendix to the report, I've had a colleague of mine go through all those controls assurance reports and pull out the exceptional items which you may find of interest or want to comment on. There are no areas of concern. We're content with the management action agreed or subsequently undertaken that the appropriate third parties have determined to implement. Nothing to bring to your attention at this point in time. Largely, as all walks of life, these control frameworks and control systems are electronically based, and as you can see, a common theme of some of the exceptions and some of the reportable items are in relation to access to the systems, password control, or you haven't deleted an old user from the system, things like that. Those are the types of exceptional items that are being reported. Management have been asked for their response, and they've implemented mitigating controls for those findings. Thank you, Chairman. Happy.
Any questions for Jeff on that item? No. All right, moving on then to item 8, which is the Pension Fund Administration Strategy Report. So over to you again, Jeff, I believe.
Thank you, Chairman. We are legally required to produce a pension administration strategy statement, and we have done for a number of years. However, it's a live document. It's continually updated, and we are and we have done so. I think it was last produced in 2017. I think it says in the report, originally produced, and so we've updated it. Sorry, 2021. It was last brought before you and approved. So since that date, it's been revised and updated in line with latest guidance, etc. And as previously indicated, this document outlines the sort of contractual arrangement that we have with employers as they get admitted to the scheme, what we expect of them, what they can expect of us as the administering authority, in terms of information flow, their obligations to, for example, to remit contributions as required on time within the stipulated guidance. So if they're not doing what they say they should be doing, that will flow through the system, and we will report it to you, and it will pop up in the breaches report, for example, that we report to you, and we will say employer X, Y, or Z is not doing what they've agreed to do as outlined in the investment and in the administration strategy, and we'll go about resolving that. I mean, you know, unfortunately or fortunately, non-compliance to the strategy doesn't mean that we can kick them out of the fund, because lots of these employers do have legal rights to access to a pension fund and legal rights to be a member of the scheme. So we do have to work with our employers, and you know, they've been shared with this investment strategy, and they are required to sign up to their obligations as well, Chairman. So this revision to the strategy is brought before you today for your approval.
Thank you, Jeff. Questions? Thank you, Jeff.
Thanks. Just one question. There's nowhere, or should there be anywhere, that with relation to our decarbonisation and biodiversity sort of pledges in this?
This is purely, Councillor Thomas, in respect of pensions administration. What do I mean by that? Is our dealings with members, employers, and the payment of those benefits and the receipt of those contributions.
Yes.
So the wider investment strategy.
Yeah. Sorry to interrupt. What my point is that sometimes that might have a bearing on the fiduciary responsibility, maybe. Like, for example, if you thought that one investment might be slightly better than another, but then it met all of our other criteria, biodiversity pledges, decarbonisation. Do we not make people aware of that in this? That was sort of my question.
Not in this document, Councillor Thomas. They'll be made aware of that in our investment strategy statement, our investment beliefs document, our responsible investment policy, which are produced and shall be updated. This is purely to do with the administration of benefits. And when I talk about benefits, the actual payment of pensions and the receipt of contributions to meet those benefits. All the items that you've referenced in your question are explicit and are available for members and employers to access as part of a responsible investment policy and our ISS, which will be updated now following the trial and evaluation.
Thank you, Jeff. All finished? Yeah. Again, this is a report that needs the approval of committee. So if I can pass over to Jeremy to take the vote. Thank you.
Thank you, Chair. You see the recommendation on page 424, and it's recommended that the Pension Fund Committee approves the revised fund pension strategy report attached at Appendix 1. Can I have all those in favour, please? Okay, thank you, Chair. That's unanimous and carried.
Thank you, Jeremy. Moving on to item 9, which is the MacLeod implementation update report. Again, this is you, Jeff. Thank you.
Thank you, Chairman. Briefly alluded to by Laura in her presentation, this is a long rumbling issue which has affected, broad pensions provision across the public sector, not just the LGPS, as a result of a legal challenge a number of years ago, where it's determined the interpretation of the regulations was discriminatory on age grounds, had ramifications for the LGPS. The remedy has long been rumbling on, as indicated by the report. We've mobilised quite a large team to evaluate and appraise the data and the membership profile of who's affected, etc., etc. But it's complex and it's very much reliant on a patch, a fix from our IT providers, Haywoods, who provide IT software for over 90% of the LGPS market. In short, Chairman, we alongside, I would suggest 99% of the LGPS community are asking for your approval to exercise our discretion to extend the deadline to implement the remedy to 31st of August 2026, i.e. give us another year to try and fix this problem. We're not alone. You know, the majority of the LGPS is still wrestling with this issue, and hopefully this time next year we'll be able to report to you that we've put it to bed. But as you can see in the valuation, it's still an ongoing unknown because of the assumptions included within that. But hopefully, as I say, with the exercising of this discretion to extend the deadline, we'll be able to implement the remedy in due course. So there will be a disclaimer in your annual benefit statements this year at the bottom. You may have noticed whereby no McLeod recognition is included. If they are impacted, it will be reported to them, included in a member's annual benefit statement next year. And recommendation, Chairman, is on 454.
Just one question, Jeff. How much impact do you assume that this McLeod implementation, when it arrives, will have on our pension fund?
As indicated, Chairman, in Laura's presentation earlier on, obviously they made assumptions on the McLeod impact on our fund within the value in 2022. I can't recall the figures now. However, they were overly prudent in their assumptions, and we had a net benefit from that assumption. So it varies on an individual by individual basis. Obviously, it depends on how old you were, when you started in the scheme. So on an individual basis, it's how long is a piece of string. But on a whole fund basis, it was better than expected. You know, it didn't impact. As a result of when they actually received the data this time in 2025, they thought when they reviewed it, they thought, oh, okay, the financial impact isn't as great as they had originally assumed in 2022. So if you saw in that little bar chart, we had a net benefit from McLeod assumptions at this valuation.
Thank you for that. I'll bring Phil in now. Thank you.
Just to back Jeff up on this one about extending the date. I'm in the teachers' pension scheme, and I'm still waiting for my money. So we're not the only ones. Okay, local government are not the only ones that are suffering from this. I think ours have been pushed back a year already as well.
Okay, that report requires our approval. So over to you, Jeremy, and take a vote. Thank you.
Thank you, Chair. The recommendation is on page 454, and it is recommended that the committee approves the fund exercising its permitted discretion to extend the deadline by the completion of the McLeod rectification and implementation to 31st of August 2026. Can I take all those in favour, please? Okay, thank you, Chair. That's unanimous. Thank you.
Thank you, Jeremy. All right, moving on now. You know, we've originally done, when we've started, we did item 10, so we're on to item 11, which is exclusion of the public. Can I have votes on whether we can exclude the public?
Okay, yeah, thank you, Chair. That's carried. I'll stop the recording now. Thank you.
Okay,